Hi, good morning, good afternoon. We are here from Paris. Our team is City of Lights, and we're very, very happy to present you some of our solutions that we come up with for Macquarie. Hello, Caleb. It was nice meeting you yesterday. All right, so going over the way, one second. Okay, the way that we looked at this problem was that the problem, we wanted to focus on some of the smaller merchants. We realized that this problem affects different merchants differently. And we wanted to deal with their problems first in a manner that was not very difficult to implement and which could also be done in a short period of time. So how we understood the problem was that the smaller merchants, they're exposed to very high price volatility. And that's also because of the expensive capital outlays, because they don't have such high credit score. So they have difficulties in getting access to this credit. And as they scale up in their renewable production, and as renewable production scales up as well, there's a downward pricing pressure. So it erodes their margins away, affecting their ability to pay off the debt. They also don't have as much access or information about tolling or leasing agreements. And they're also not as aware about how to hedge the price volatility. So we wanted to create a platform, sort of an app that would aggregate all these solutions together. And the three solutions that we looked at were tolling, we looked at some hedging mechanisms, and we looked at how we can possibly change the policy, which will revamp the power market. So Zach is going to talk more about tolling.
Right. So tolling contracts offer the opportunity to alleviate the zero marginal cost market disruptions caused by adding further solar and wind productions. Currently, because renewables such as solar and wind do not have positive marginal costs, there's no disincentive for renewables to reduce output. As you can see, that we've seen negative prices as a result. Tolling agreements offer the ability to lease capacity, not production, to the market. Rather than being subject to highly variable and often negative prices, producers would then have stable and consistent cash flows. Offering full or partial tolling agreements offers producers a much more attractive potential for further investment due to those stable and consistent cash flows. Right to Aditya.
Right. So thank you, Zach. So after tolling, we can also look at hedging mechanisms. And what we wanted to create was that, so in 2018, like CAISO approved that we can use hedging, and that is a good way. They suggested it to go forward. And what we thought that we could do was that we can create a platform that will aggregate different market players and connect them better. So it will sort of remove the misinformation, they will remove the barrier to entry. And what this platform will do is that it will get suppliers, will get merchants, it will also get buyers, and will also get third parties. And this will allow the merchants to connect with each other if they want to engage in swaps, and they can also connect with third parties if they want to buy averaging swaps. And this will reduce the sort of the volatility on the higher end, but also on the lower end. And we created a case here, which was based on 2025 prices. So if you look at it with hedging, the way that we went ahead with this was that all the negative prices that we had, we wanted to sort of be able to remove them with a minimum of 0. And the difference would be taken away from the higher end on the prices. So the prices then start looking more like a contract agreement. And this allows, this reduces the cost of debt, reduces the WACC, and also allows higher debt ratios to be involved in funding of the projects, which again elevates some of the credit restraints that they might have. And once we have a critical mass of these hedging providers, these swap providers, we can have competitive bidding, which will lower the price down further. And we can also have some interesting instruments on here, something like a weather derivative that will again hedge some of the price involved with renewable power generation. Now, Bengisi will talk a bit more about policy changes.
Hello. So we thought about how we could change the market structure to integrate renewables more easily. First of all, introducing smarter tools for the market could help with that. For example, we have really steep production curves when we look at renewables. Having 15 minutes or smaller granularity products instead of hourly products could help a lot and ensure that we are selling everything that we produce. And on top of that, we thought about creating further auctions, not just one day ahead, but also intraday auctions, and also auctions for 15-minute products. This could also help integrate renewables more in the system and maximize the profits of a solar power plant or any other renewable power plant. Also, currently we have 75-minute difference in CAISO between the end of closing the order book and delivery. This duration could also be reduced if we want to really integrate all the renewables that we produce, renewable energy that we produce. Another thing that we thought about is encouraging power trade, just like we do in Europe. When two different zones have a trade between themselves, especially like California with another neighboring state, if they don't have as much renewables, probably their price differences will not be so high. So if there is a trade and if the capacity, the transfer capacity is optimized together
Thank you, City of Lights team. Time is up. Let's start Q&A session.
Okay.
All right.
Well, thank you.
Cool.
Thank you.
We didn't really hear the warnings though. Did you send us?
I just posted on Zoom chat.
Okay.
Oh, okay. We didn't
Alright.
see that.
Yeah.
It's okay. I was almost done.
No
Thank you
worries.
for listening to us.
Yeah, for the last slide. Thanks.
Thank you very much. Yeah, so I guess my question, maybe starting with the hedging mechanism. So are you proposing that kind of Macquarie set up a platform to do hedges? That this would largely be kind of a trading function that we would then do with the assets that we're looking to build and develop. Maybe just kind of speak a little bit to what you would propose, kind of Macquarie's role, in this platform, and how it may differ from what is currently done.
Right. So the way that we approached, like the way that we looked at it was that initially somebody would have to build a platform, and that could be Macquarie, or that could be any other tech company. Maybe can be a startup that is under Macquarie in that sense. And Macquarie's role on that would be, initially Macquarie can be, if Macquarie doesn't want to be the aggregator or the purchaser of the price to hedge it, it can be the provider of the averaging risk. So it can be averaging hedge. So it can be the third party who takes that position, contrasting to what the producer has. It takes on that exposure for the premium, and it makes money on that premium. And eventually, over time, Macquarie can bring other third parties, other financial institutions to take this position. And if it's not comfortable, or if it's not making enough money, then it can sort of exit and let others manage it. So how we looked at it was that initially there will have to be like one big financial institution or somebody who can support the hedges. But eventually, because there's a profit involved as well, to some extent, that others will flood, or others will come to the platform, and then it will be like a competitive bidding system. So if Macquarie is not providing the best prices, or the best is charging too high a premium for the hedges, then somebody else can do that.
Got it. So the idea then is kind of instead of Macquarie participating in the market by, I guess, developing projects and kind of facing that merchant price exposure, you have a business model where you actually become a trader, where people with projects could come to you, they can buy hedges from you, but then you are able to make a premium off of kind of those hedging contracts compared to the revenue you think you could make. Is that what you're proposing?
Yeah, exactly. So initially, this will have to be there will have to be an understanding, in the sense that for different producers, you're going to either make a small profit on the hedges that you're providing, or you're going to make a slight loss based on how mature, how sophisticated that producer is. But it is going to average out if you have enough critical mass. And we are assuming that there's always going to be a small premium, and that small premium is going to attract other third parties to do the hedging. So Macquarie, if it feels it's yeah, but whether there's a premium or there's a small loss, it will still get more sellers or more merchants onto the platform. And that is eventually good for the market, because it's going to it's going to average the prices, and that's going to get more business to Macquarie for building these assets, or sort of, it's going to bring in more sort of development for renewables.
Got it. And then, maybe just a follow-up question if we have time. So this idea of kind of shifting a power market from, day to more granular, how do you see having kind of shorter duration bid periods, hour, 15-minute, even 5-minute, you see in some markets? How does having kind of that resolution, significantly higher, change your exposure to risk in power markets or in merchant markets?
So when we sell it hourly, there's an amount that we are not taking into account. There's an energy that we're producing, but we're not selling necessarily on the market, or we're not buying. It's being lost because of the steep curves. So basically, introducing more granular products are helping, are making sure that more of that energy is being included in the volume that we're putting on the market. Was your question about that, or about the shorter duration from the end of?
Yeah, and I was just curious how would that impact you know, the wholesale market prices? Would you expect that to lead to kind of lower or higher volatility in the wholesale market pricing if you went to more granular products?
More granular products, I think it would make sure that whatever is produced is introduced into the market, and we would reduce over-the-counter trading through this. And the more volume we introduce into the market, the more liquidity. The more liquidity, it means lesser volatility of prices.
Okay, cool. I think I'm following you now.
So now time is up. Thank you, City of Lights team, for your presentation.
Thank you very much for your attention.
Great. Thank you. Thank you very much.
Thank you.
Was this the last one today?
I think so, yeah.
Okay.
Oh,
all right.
great.
All right. Thank you.
Good to see you guys.
Bye-bye. Thanks,
Cool.
Caleb.
Thank you. Thank you.
Bye.
Bye. See you.